Good afternoon, I'm Victoria Hart. I manage the portfolio for Pinnacle View Capital. I'd like to thank Whitney Tilson, Glenn Tung, and Kase Learning for this amazing conference. I'm going to share some thoughts on Pandora. Let's start with a brief background on the company. Pandora is the world's largest jeweler. It's best known for its charm bracelets, which account for 3/4 of its sales. It's sold globally in over 100 countries. It's vertically integrated with manufacturing facilities in Thailand. It operates both a wholesale and a retail business with over 1,000 company-owned and operated stores. The company is headquartered in Denmark and first traded as a public company in 2010. Pandora has a market cap of $12 billion US and trades at a forward PE of 12.5, representing a PEG ratio of 1.5. 2018 consensus in US dollars is $4 billion in revenues and $9.24 in EPS, representing 7% and 8% respectively year-on-year growth. The stock has seen some pressure since mid-2016 when it hit its all-time high of 1,000 in Danish krone. Today, the stock is at an interesting inflection point where it's recovered off of the low made in February. And now the question is whether the worst is over or there's more pain to come. There's a bull-bear debate on this stock. A depressed multiple is no reason to own a stock. Cheap can always get cheaper. In my opinion, Pandora's stock can trade 30% lower from today's price. The short thesis rests on deteriorating fundamentals and declining ROIC. Our view is supported by the following 7 key pillars. 1, its namesake product is a fad. 2, working capital analysis suggests channel stuffing. 3, recent resignation of 3 top key executives. 4, deterioration in same-store sales. 5, masking anemic organic growth via acquisitions and unit expansion. 6, deteriorating margins. And lastly, 7, a shift to a more asset-heavy business model, which paired with declining margins erodes the company's ROIC. Catalysts underpinning the short thesis are upcoming earnings events when weakness in the underlying business will be more readily apparent. Supporting that view are several operational headwinds, which I'll elaborate on in my presentation. Major risks to the thesis are: 1, they've announced an increased buyback plan that could reduce the share count by 6%. And the e-store initiative is stimulating new demand and carry the top line. So we've seen this story before. Brands are not indestructible. The life cycle of a new fad is about 3 years, which Pandora has hit. Other iconic and loyal brands have tried to extend their products with little success. I referenced Vera Bradley up here, as the history of Vera has many parallels to Pandora, and Vera's share price had a painful journey down 80%. I also make reference to the Saturday Night Live skit on Pandora. For those of you who haven't seen it, it's worth checking out for a great laugh. The first red flag in the stock is fashion risk. 3/4 of sales come from charms and bracelets. Their brand has become synonymous with charm bracelets. While Pandora's management hopes to rebalance the product mix by 2022, it's hard to share their confidence that the customers will pivot that fast for a seamless handoff. The math can work out in a number of ways, but based on our assumptions, the 50-50 split implies a mid-teens revenue CAGR for the next 5 years on their other parts of their business in order to offload the burden of the declining charms and bracelets. And that seems overly ambitious in our view. Looking deeper into charms and bracelets, this category is akin to the razor blade business. The company sells a bracelet, and then they have evergreen sales from related accessories that are very high margin. I illustrate this as step 1, 2, and 3 on the slides. But since 2016, the purchasing demand in step 3 has changed. A telltale sign of the fashion fatigue in its charms business is the ratio of charm sales to bracelet sales, which has declined by over 40% in 2016. This lower purchase pattern has broader implications with regards to the customer retention. The model to date has relied on selling more jewelry to its existing base. 85% of its customers are existing and represent 70% of total sales. If the loyalty it has enjoyed is predominantly tied into bracelet and charm sales, then lower charm sales implies declining store traffic. More scary, however, is that once this trend ends, if the company cannot convert their customers into other product categories, sales can plunge fast. Jewelry is predominantly a gifting category, with 74% of Pandora's sales tied to gifts. Major holidays are Christmas, Mother's Day, and Valentine's Day. The average transaction value is about 110. The demographics are broad, with the millennials as the focus group. Based on consumer studies Pandora has commissioned, the product is viewed as fun and everyday pieces. Their product is affordable, not luxury. Their pieces, therefore, are not considered timeless nor aspirational, which makes them subject to fashion risk and staying on trend with the latest fashion bug. Pandora is a marketing juggernaut. It entered the US market in 2003 and has since grown a prominent, well-recognized brand today. If you look at the graphic on the bottom right-hand part of the slide, it outlines the brand positioning in the jewelry market. They sit in the orange shaded region, which represents the everyday and affordable market segment. Pandora has gained share by establishing a branded product in a segment that didn't have strong leadership and is largely unbranded. With 70% of its products priced under $100, it's a volume-driven business model that relies on a high cadence of new product introductions and promotions. That type of model limits the degree of freedom they have for upselling to higher price points. They are essentially the fast fashion leader in the jewelry category. While it's had a phenomenal growth spurt, the low-hanging fruit has been captured. Incremental share points will be harder to gain in established markets. Hence, the company continues to sprawl into new emerging markets. At the end of 2017, 60% of its revenues were in declining or saturated markets. Based on the market forecast for jewelry demand by Euromonitor, overall category growth in the US, Italy, France, Australia will be flat or down in the next 5 years. Those 4 markets represent 48% of Pandora's sales today. In addition, if we add in the UK, where Pandora's market penetration suggests saturation, that brings us up to 60% of Pandora's total revenue being generated in declining or saturated markets. The markets that are projected to grow above average are China and India. Pandora just entered India, and China accounts for 7% of total revenues today. So what happens to a volume-driven business model that has reached saturation in 60% of its markets? Well, same-store sales start to decelerate. If you dig deep into the numbers, you see that same-store sales at physical stores have been decelerating, and growth is being driven off of e-commerce, unit expansion, and acquisitions. On the upper right-hand chart, I decompose the like-for-like sales figures the company reports. There are the blue bars, which get reported as this nice, steady, high single-digit growth rate. However, what has actually fueled that growth has been almost entirely e-commerce sales. When reviewing the financials, if you take the extra step to strip out the internet sales, you actually see that same-store sales in its physical stores have gone soft. On a consolidated rolling basis, which is this chart at the bottom, total top-line growth is nearly all driven by expansion efforts. The blue bars at the top, which represent like-for-like sales, are carried down into the bottom chart. And as you can see, total growth is dominated by other categories, the red and yellow bars, which represent new unit expansion and acquisitions. The first domino to fall has been the US market. It's the company's largest and most mature market and represents 23% of total sales. US same-store sales at physical stores have gone negative. 75% of the company's footprint is in malls, which are experiencing a secular decline in traffic due to overbuild, shift in e-commerce, and consumer spending preferences for more experiential activities versus material possessions. Red flag number 5. A self-help story with leadership defection in recent months is troublesome. 3 key executives have resigned since the start of the year, namely the CFO, President of Americas, and Chief Marketing Officer. Such a vacuum places great risk in executing its 2018 guidance targets. And this is a company with a revolving door history when it comes to its CEO. Additionally, the incentive scheme creates a misalignment of shareholder interests by rewarding growth without accountability for profits. The next red flag is a favorite find if you cover the consumer sector as a short seller. It's channel stuffing. Analysis of working capital suggests the company tried to boost reported sales figures in late 2017 by stuffing the channel. DSO has increased by over 30% in the last 2 years. In a model that has the wholesale channel, a company can push merchandise into its distributors to make its numbers. The problem with that is that it causes inventory overhang in the system, whereby in future periods, merchants will accept either less product until the inventory clears, or they'll return it. I suspect that 1Q sales will be disappointing as a result of this overhang and creates a burden on the rest of the year to catch up to meet full year expectations. Further, it should be noted that a company, when it shifts to a more asset-heavy business model, creates more working capital needs, which thereby also lowers their free cash flow conversion. Red flag number 7, incremental revenue growth is lower quality. The change in product and channel mix has resulted in lower EBITDA margins, and that is weighing down on EBITDA growth. As the company shifts to more company-owned and operated stores, it props up its top line, but nets to a lower EBITDA margin. The change in product mix has also been dilutive to margins. When the company doesn't disclose margins by product line, we've done our own digging by speaking to our industry contacts to understand that the highest margin products they produce are indeed the charms. Their attempts to also invigorate demand with new products has depressed gross margins. Recently, they launched the Shine Collection, which is a gold-plated line for them. While most of their manufacturing is done in-house, they currently outsource gold plating. They intend to have this integrated later in the year, but gold plating is a more expensive part of the manufacturing, and in the near term, again, will suppress margins. We also see a risk to margins from any changes in commodity costs of silver and gold, which are still priced below their relative long-term averages. The next red flag is how the change in business strategy is value destructive. The company is accelerating its plans for company-owned store openings and buying in franchisees. We personally view this decision as a poor one to make with regards to capital allocation decisions, given how we noted earlier that the same-store sales as physical stores have been decelerating and have gone negative in some cases. When sales soften, the best course of action is to hit the brakes with regards to unit growth. Otherwise, your returns on invested capital start to deteriorate. And the chart at the bottom of the page, you can see that that indeed is starting to happen. ROIC declined by 9 percentage points last year alone. When considering all the implications of the company's strategy, we question whether the company is desperately trying to grow the top line at all cost. Lastly, it's worth noting that the shift from an asset-light, high-margin business to an asset-heavy business impacts valuation. It supports re-rating of the company's valuation lower based on the fact that the company's ROIC will deteriorate and the business model is more vulnerable to economic recessions. Relative to its peers, Pandora trades at a discount. So part of this story is already baked into valuation. It still trades at a premium to Signet. So if Pandora continues to disappoint on earnings, there's still room for multiple compression in response to a lower growth and profitability outlook. Even without re-rating, estimates are too high and they'll miss on earnings, whereby the stock will react in response. With regards to valuation on the stock, in our opinion, the stock could trade down 25% or more from current levels, which would mean a share price of around $500 in local currency versus last Friday's close at $700. We arrive at our price target by assigning an 8x EBITDA multiple to our 2019 estimates, as well as running a DCF. Given our view on how the company's strategy may be destroying value, we feel a re-rating lower would be appropriate. We have chosen a level we feel is in line with the profitability and organic growth characteristics of the company. Our view differs from where the stock is trading because of the way we've identified our forecasts. We believe that 2018 and 2019 consensus is too high. We highlight a small part of the assumptions behind our forecast versus consensus on this slide. It'd be too much to share all the variances in our estimates versus consensus, so for simplicity, I've highlighted how we differ with regards to revenue. We model the growth rate for revenues to be 5% versus the street's 7%, and our buildup on how we arrive at it is shown here. Risks to our thesis. The company has a share repurchase program that it announced in 2018 that allows them to buy back 6% of their shares outstanding. And two, the second major risk is that the e-store business is targeted to double in the next 5 years. I suspect that 1Q sales will be disappointing as a result of this overhang and creates a burden on the rest of the year to catch up to meet full year expectations. Estimates are too high and they'll miss on earnings, whereby the stock will react in response. Thank you, and if anyone has any questions, I'm happy to take them during the breaks.